All right, everybody, welcome to another study time with Steve.
Woo!
I'm gonna give another 1 or 2 minutes for people to
Stragglers.
hopefully join. Yeah, well, it's 9 in the morning. I understand.
I get it. 100%. 100%.
Yeah. While we wait, Claire, give me a vibe check on Gen Z.
Oh
How are
man.
how are the Gen Zers feeling currently?
What a good question. Gen Z is pretty much always in the trenches, if I'm being
Okay.
honest. But I believe in our generation. We will have a time. I always say that, when the boomers need help with creating a PDF, that's what we're here for.
There you go.
So there are purposes for us, but I think, in the world, whether it's Gen Z or you're a recent retiree or whoever you are, between gas prices, we have a war going on, there's lots of different things happening, but I am an optimist at heart. And so I believe that, we're gonna have our time and I feel like we're resilient. So
How,
it's a good
How would you say
generation.
your friends are feeling? Like, when you talk to friends, how are like, do they have the same optimism as you?
What's funny is I feel like with Gen Z is that people probably look at us and think we should be a lot more worried than we actually are. We just
Yeah.
kind of vibe it out. I mean, we're like, you know what? We're just going to take it day by day. Should we be planning more for the future? Probably. Yes, we should. But I think a lot of people my age, we're just trying to figure it out because there is a lot in the unknown. And we're just trying to say, hey, can we work? Can we figure out this adulting thing?
Yeah,
We're
right.
just
Yeah.
going to take it one step at a time. I have friends getting married, friends having babies, and I'm like, I'm just going to focus on the married part for now, and we'll figure all the other stuff later. So,
Sounds
Gen
good.
Z's doing okay. I believe that we're going to be just fine.
All right. Yeah, and we'll get to more about why I even asked that later in the talk. But Jay, if you want to bring up the welcome slides, we can go ahead and start.
Yeah, let's get
So
into it.
again, this is study time with Steve number 2 for 2026. Today, I'm Steve. I'm Steve Gormley. I'm the director of portfolio management for KWB Wealth. I'm joined today by Claire Lucchese. She is a CFP and a CHFC with our firm. And one of the big reasons I wanted to invite Claire on, and she's going to touch on a lot of planning topics later in the presentation, is because I'm pretty sure that Claire has been in more meetings than any other advisor over the past 5 years that she's been with our firm because she was working with Mike and Diana and Carrie and Rachel and Quentin. She was working with all of our advisors through that whole 5 year period.
Been a great
And now,
journey.
yeah, no, but
Yes,
you've probably been on more meetings than any other advisor that we have in the firm. And
I agree
so
with that.
it's great that you're going to talk about like kind of the top 5 topics that you've heard over that time frame. And so we'll get some real good insight into, yeah, this is what advisors are asked and they talk about all the time. So
Yes.
really excited about that. So Jay, if you go to the next slide, this is the disclosures. Very important. The one thing I always like to say here, as you read the disclosures, that everything that we say today is just Claire's and my opinion. It's not the opinion of KWB Wealth. This is just us kind of having. You get to drop in on a conversation that
This is
Claire
like
and
a
I are
normal
having.
day.
Normal
Yes.
day. All right, so let's go ahead and get started. Let's go to the first chart, Jay. And so the first thing I want to talk about, and you probably have all heard me talk about this many times, but just start talking about earnings and what earnings mean over the long run. So this first chart shows how earnings have really catapulted over the last 12 months and the expectations of earnings over the next 12 months for companies in the S&P 500, the mid cap S&P 400, and the small cap S&P 600. So each one of those is having its own kind of boost in earnings over really just this last quarter is where the expectations for earnings has ballooned, and especially in the S&P 500. So, the largest companies are proving through their earnings, through their outlooks, that things are getting better and that the consumer is doing well because the earnings are there to support them. So, if you go to the next slide, this is probably my favorite slide that I've seen over the last, say, 6 months to a year. And this breaks down the contributions of where returns come from. Really, in anything you think about, there's only three places that returns really come from. It's dividends, which are pretty small nowadays. It's about 1%. So at the end of this year, that dividend column will show a positive 1%. Next is earnings. So earnings is currently taking up all of what the total return of the S&P has been for this year, which is actually a great thing. That means that consumers, that investors are not out there really speculating and saying, "Man, I hope that earnings show up, but I'm willing to pay a little bit more
A
for that
strong
stock."
foundation with earnings.
A huge, strong foundation, and like this is the exact setup you want to see. Like we have really great returns for the year, and no one is out there speculating and saying, I'm going to pay up for this
There's no
stuff for the
fluff.
stuff."
There's no fluff.
No, it's all based on earnings, which is such a great setup. I mean, there are definitely years where you see, hey, it's all based on there's a lot of exuberance out there. There's a lot of, that PE multiple, the price that people are willing to pay for each dollar of earnings is much higher. And so in this environment, this is perfect. This is what you want to see as an investor. This is what I love to see as someone who's building portfolios because we know that it's earnings that are driving the picture. It's not just the price
Fears
of
of bubbles
everything.
go away too when we see
Yeah.
earnings like this.
So
Exactly.
what you know, Claire, you've been in the industry a few years, and you've been through 2022, which was really rough.
I
You've
just
been through,
started then, so very early on. Yes.
but yeah, I mean, like talk about how you think about the market and how you think about earnings. Because I pound the table for everybody to like, hey, when you're talking to clients, you should be talking about how rosy the earnings picture is. So what do you usually talk about with clients when it comes to the market?
It really depends. I mean, I think a lot of what's happening right now and just in general, there's almost this sticker shock. I mean, just prices are really high. And so
Mm,
a lot of people get fears of like, are we in a bubble? Are things too hot? What's happening? And so that's where we kind of come back to the earnings and say, okay, is there a fundamental reason to support these valuations? And based on what we're seeing, there is. As
yeah.
far as AI is concerned and technology, I'd be lying if I said there wasn't probably a little bit of fluff in there, of course, because it's still very new. But I
Hmm.
think when we look back to things like even 2008, and we look at, the tech bubble that happened, in the early 2000s, late 90s, that was all driven by really high valuations with very, very little earnings. And so
Yeah.
I always try to come back to that. And I feel like every time we have recession, we learn something new. And hopefully we have longer periods of time where we don't have recessions as much. But I think we always have to look at what's the underlying reason in the economy. And it's that, and also too, we're 70% driven consumer economy. Am I
Yeah.
spending? Yes, I am. Are my friends and family spending? Yes, they are.
Yeah.
And so
Right.
I come back to that too of thinking of myself of, yes, do I think prices are high? Absolutely. But we're still spending, we're still doing things, people are traveling. And so I think as long as we have those things, of course, there's going to be some bumpiness, along the
Yeah.
way. But the earnings really drive reason to say it's hard to see recession in sight
Yeah.
right now.
Right. Yeah. Over the long run, earnings is what drives the stock market. It
100%.
ultimately comes down to that. And so, Jay, if you go to the next slide, this is my last slide. And the reason I brought I saw this chart in the context of, oh, isn't this a bad thing? Isn't this a bad thing that the population of the United States is only 4.2% of the world's population? The GDP of the US is 26.1% of the world's GDP. So you can see, from a 4% of the population to 26% of GDP, the US is really driving the world economy, which is fantastic. And then you go to the market cap of stocks around the world, and the US makes up 64% of the world's stock market.
Crazy.
And I'm like, the chart was shown to me it was like a bad thing that this is the context. And I'm like, doesn't that just mean like the US has the best companies in the world? Like, ultimately that's what it is. And so I wanted to do this poll. And so I want to launch the poll because let's see, how can I don't see it in here anymore, Elena. We had a poll question and I wanted to poll everyone to see, let's see.
Well, we get that up. I'll tell. Or here,
There
hold
it
on.
is. There's the poll question. So, how many $1 trillion companies are there in the world? And the reason that I gave the different ranges as opposed to an exact number is because on a day-to-day basis it might fluctuate.
Yeah.
So, because markets move, there might be some amount of $1 trillion companies today versus some amount, tomorrow. And so go ahead and answer this question. And I want to see what people think. How many $1 trillion companies are there
While
in the
people are
United
answering that,
States?
I'll tell a quick story. I once was living with a host family in France, and I had a young host sister who was in high school, and we were watching the news one time. I think Trump was on, something like that. And I was shocked that they were watching the US news. And she told me, she said, I don't think you understand that the US is the center of everything. Even in Europe, everyone is focused on what the US is doing. That was the first time in my life I was like, wow, living here, you just don't realize that. But US
Yeah.
is a powerhouse and we need some wins for the USA, definitely. So I appreciate the chart, Steve.
Yeah. Okay. So let's see the poll again. I want to see how people answered. Let's see. Is it available for people to answer? I don't see the
This is why
numbers
we're not head
coming
of
in.
technology,
I
Steve.
know this is, yeah, for sure. All it says is that I can't vote. It doesn't say anything else about like what's going on. There we go.
There
Okay.
we go. Yeah.
So the overwhelming majority say there are 4 to 7 companies that are over $1 trillion. Number two is 12 to 15, and that's the correct answer. So the correct answer right now is there are 14 companies that are over $1 trillion in valuation. So
How
worth
many of those are US?
10,
Wow.
10 out of the 14. So the top five are all US companies. And so the first one that's not is Taiwan Semiconductor. And then, it's incredible to me how strong American businesses, the fact that we get to participate in that, like I said this in our outlook for the beginning of the year, the fact that we get to participate by owning these stocks, by owning these companies, is it's just incredible to me. The fact that we get to build wealth by owning companies like this is just awesome. And so when I see that chart, and it was given in the context of it's a bad thing that the U.S. is 64% of the world market cap. I was like, no, that to me just means, man, America is really great at building great businesses, and
100%.
and I think that'll continue. So those are my thoughts that I've been thinking about as we've gone through this year so far, and how incredible earnings has been the driver of, man, I'm very positive for the rest of this year for sure. Yeah,
I couldn't agree more. Yeah,
yeah,
I mean, obviously there's a lot of things about the US, but I believe we're resilient. I mean, same thing with Gen Z. I believe I'm an optimist. I believe things are going to get better. If you look back, I was telling somebody that if you look back to like 1910 and you told somebody at that point in time that, only 2% of the world's population would be in agriculture today. Look at how much the world has changed and,
yeah,
growth and development. And it's even though it can be hard because we're living in transformative times, the world gets better and better. The US gets better and better. And so I feel like we have to believe a little bit in that optimism, even in the midst of some short-term volatility and some uncertainty.
yeah, for sure. All right, Claire, let's go into your part. And
Okay.
one point I want to make before, as Claire's going through her talk, please feel free to go down to the bottom and add any questions you have
Yes.
down in the bottom so that we can answer those either as they come or at the end so that we have those questions lined up.
Yeah, so Jay, if you don't mind pulling up our first slide. So, as Steve mentioned earlier, I've been lucky enough to sit in on many, many meetings over the last 5 years, especially recently. When we were kind of thinking of the content that we wanted to present, I was like, what are like the, 3 to 5 most relevant topics that people are actually asking about in meetings? And so the first one is Medicare. And so I have to just start with a disclosure of we are not healthcare experts. We are not Medicare experts. I'm certainly not. So maybe go easy on the questions if it's about Medicare. But it is something that's super important and it's something that affects relatively everyone once you get especially to that 65 mark. And so I kind of want to focus more on the financial side of it, on the facts. As far as healthcare coverage is concerned, we do recommend seeing a licensed Medicare specialist when picking which plan should I be on, how it works with my, employer or retiree coverage. We are not doctors. We do not know what the best thing for you would be there, but there is a lot that goes into it financially. And so, as far as Medicare is concerned, if you are getting to the age of 65, your enrollment window starts 3 months before your 65th birthday and then 3 months after. So a total of 7 months is your enrollment window. As far as if you are turning 65, you need to sign up. If you are covered through an employer plan, you may be able to delay your enrollment. As I said, not a Medicare specialist, but something that you need to be aware of, especially as you're reaching the age of 65. Something that has come up so often is IRMA, income related monthly adjustment amounts. This is your Medicare premium. Often people will tell me, why did my Social Security benefit go down? The reason for that is because your Medicare premium probably went up. And so if you're already collecting Social Security, you're already going to be automatically enrolled in Medicare. And so when you start your, Medicare benefit, they have a premium that comes out of your Social Security. So to start, it's $202.90. You can see that from the chart here. It goes up. And so everyone is on a different Medicare premium schedule. How it works, and this is probably the most surprising fact to most of our clients, it's a 2 year look back. So when you turn 65, your Medicare premium is going to be based off your income from when you were 63 years old. It's 2 years prior. So if you sold a property, if you did a big Roth conversion, if you had a lot of capital gains in 1 year, you could have 2 years later an increased Medicare premium, especially if both you and your spouse are collecting, if you're collecting Social Security, if you're on Medicare, that premium increase could be drastic. It could be, $3,500, $4,000 difference in monthly income for a year, depending on what your income might be. The other part of this, it's a bracket cliff. So if you go $1 over that threshold, you are automatically in the next Medicare premium bracket and it goes up. And so people will say, are you guys watching this? Are you guys looking at this? The answer is yes, we are watching it. And so it's important that you keep in mind if I am retiring or I sell property or there's some big income event on your tax return, that it's going to affect you Medicare wise if you are at the age of 65. So it is something that we are planning around. And it is something that you should be very, very conscious of because again, $1 over could result in, a couple $1,000s difference in, that deduction on your Social Security. So, okay, that's my Medicare talk. I'm sure we'll probably have some questions. As if, retiring wasn't confusing enough, Medicare is a whole other slew of things. There are lots of questions that go into that. Next slide. This is a good one and it affects most people. RMDs, required minimum distributions. For most people that don't know, whether you've inherited an IRA account or you have put money away in a 401k, this is I see like people thumbsing up. I'm like, everyone knows about RMDs. So what this is that you got a tax deduction putting that money into those accounts. And this is the IRS saying, I want my tax money back. And so this is mainly focused on people that have IRA accounts. And so as of right now, you either have an RMD age of 73 or 75. It depends on your birthday. This is a hypothetical example. If somebody had $1 million portfolio, they were in the 22% federal tax bracket, what their expected RMD might be. Also, this will affect your Medicare premiums. Keep that in mind. It all loops back together. This is why planning is so important. So if you're 73 years old, you have $1 million IRA, your expected RMD would be about, almost $38,000. You can see that by the first yellow bar chart there. That's almost a 4% distribution from your account. If we assume a hypothetical 22% tax bracket, that's $8,300 in taxes. And so it's important that we work with you to understand what your expected RMDs are going to be because they affect you Medicare wise, they affect you tax wise. And so as you get older, of course, that amount increases. Same thing if you have inherited an IRA account. You may have that 10-year window. You don't have exactly the same rules as here, but the rules still apply as far as taxes are concerned. And so it's something that we always are monitoring. We're always trying to plan ahead for. And so it's something that, make sure that you're aware of it. Next slide. This is kind of on the same topic of RMDs. If you are charitably inclined and you have an IRA and you are over this interesting age of 70 and a half years old, there's something called QCDs, qualified charitable distributions. It's one of the most tax efficient strategies for gifting in retirement. What it is that just going back to that, previous chart of the RMDs. Let's say, for example, you have an RMD of 37,000. You'll see that from the two pictures here back side by side. Let's say you want to give charitably. If you decide to write a check to a charity, you don't get, unless you itemize, you don't get that deduction. So essentially you're paying federal tax on the full amount of your RMD, $8,300, similar example that we just went through. Option B, again, you have to be over 70 and a half years old. If your RMD is 37,000 and you want to contribute 15 grand to a charity, if you do it out of your IRA, it is above the line deduction. It can save you significantly on taxes. It also helps you out with your Medicare premiums and your Social Security taxation. When you look at above the line, it shows, okay, I took out $37,000, 15 grand of it went to a charity. That is not taxable. So between these two options, whether writing a check to the charity directly or writing a check from your IRA account, you could save $3,300 in taxes alone just by doing that QCD. So it's something that a lot of people are not aware of. They're very surprised. But if you are somebody, maybe you're not quite to 70 and a half yet, also just a disclosure on the 70 and a half, the IRS never updated the QCD rule from Secure Act 2.0. And so the RMD age used to be 70 and a half. They moved it to 73. They never changed it for the QCD rule. So it is a unique part in the tax code. And so something to definitely take advantage of. The QCD does count towards the RMDs. So if you're charitably inclined, you have RMDs and you're over 70 and a half, let's talk. Next slide. This is a really important one and it applies to everyone. This is also your reminder to check your beneficiary designations on your accounts. If you're working with us, we're definitely going over that with you. But there's a lot of misconceptions about this, a lot of questions. Number one, should I name direct beneficiaries or my trust as my beneficiary? It depends, but most of the time, and just trust me on this, name direct beneficiaries. The trust can be helpful for naming beneficiaries on things you can't normally do, things like a home, things like IRA accounts. Your will does not matter when it comes to these types of accounts. A beneficiary form will override that will every single time. List direct beneficiaries, don't list the trust. The reason for this, the trust tax brackets, essentially, you reach the 37% tax bracket in a trust at $16,000. For individual or, married filers, you don't reach the 37% tax bracket until $600,000. And so it can create a massive tax liability. There's also a lot of other nuance to it as far as distributions are concerned. Just trust me, name direct beneficiaries. You will thank me later. But it's things like homes, other things you can't name beneficiaries on, the trust can be very valuable in that. But for retirement accounts or investment accounts, it can be helpful to name direct beneficiaries. The other part, and I was looking back at some of our old LPL forms, and there wasn't even a spot on the forms back in the day to do this. Per stirpes versus pro rata designations. It's something that I think has come up probably more in the last 10 to 15 years. What per stirpes means, and this also would apply to a trust as well, is if you are married couple, you have two kids. If something happens to the married couple, you want all your money to go to the two kids. If one of the kids predeceases you, Do you want their share to go to the other sibling, or do you want it to go to their children, aka your grandchildren? It depends. If you want it to go to their grandchildren, you don't want it to go to the other sibling. That is called per stirpes. If you want it, I don't want, some people are like, I don't know if I love my kids' family and their kids. I mean, that's a whole other slew of things. But if you don't want that and you specifically want your two kids, for example, to inherit the money, you want to keep it as a pro rata designation. The same thing applies in a trust. If you are working with an attorney or a paralegal to do that, then it's important that you designate how you want the money to go if one of them were to predecease you. The other thing, biggest question we've been asked lately, and it's an interesting one. Some people say, I'm going to name one of my kids as beneficiary, and I'm going to tell them that it's their job to distribute out the money to the other siblings. Just don't do that. Just again, trust me on that. The reason why is because then that kid is responsible for all the tax liability. That would be, a very high burden for that person. And also too, it's not guaranteed that they would follow in your wishes, even though you may think that they will. My dad's on this call. I will follow in your wishes. Just kidding. But anyways, so it is important that you keep in mind of the tax implications of what your beneficiaries are also going to have. So again, those are some of the biggest planning topics that we've been talking about with clients. But every situation is different. There can be certain situations where a trust may make sense on a retirement account. But if you think that's you, let's talk about it and we can tell you what the right answer is. So there's kind of my slew of things. Do we have any questions? Do we want to jump into other things?
I got one question here. It's more about like kind of back to the earnings. What do
Okay.
we think about U.S. exceptionalism and is it sustainable and why so? And so when it comes to that, like I believe in US companies, but we are never ever just allocating to US companies and we're never just allocating to large cap companies. We are diversifying across a basket of securities. We're going internationally, we're going to emerging markets because honestly, we don't know what the next what the earnings of the other countries might
I mean,
be
look at
and
international this last
yeah,
year. International's
exactly.
killing it.
Yeah, exactly. So it's one of those things where we are always diversified. And so it doesn't matter if we think US exceptionalism is a sustainable trend or not, because we're going to have a very diversified experience when we're investing in our stock models. And so we're going to be invested across that and we're going to have bonds and we might have alternatives, depending on the situation. So there's lots of different things that we can do that means, yeah, we still believe that US companies are the best in the world, but we're also not putting all our eggs into that one basket.
I'm also a huge believer in globalization. I'm even though I'm very, I believe in the US, I think that we're going to continue to be kind of the superpower. I still think
Mm-hmm.
globalization serves a very important purpose in the economy. But as Steve said, it always comes down to diversified portfolio in pretty much any situation. And so I feel like the winners of kind of going forward are going to be those that are diversified. If you were heavy in tech or if you were heavy international or heavy in gold, you may have done exceptionally well for this year, but the trends going forward, it's tough to say. And so I think
Yeah,
diversification always wins out, no matter what.
100%. But yeah, my favorite quote, like literally of all time, is diversification means uh, accepting good while giving up on great, but avoiding terrible. Like,
Yeah.
that's ultimately what it comes down to because, by diversifying, by being in different buckets, by being in cash and bonds and alternatives and international versus US, you are spreading the wealth and saying, hey, there's going to be some things that I don't like in this bucket or in these buckets for a certain time, but I'm really going to like them at another time. Yeah. Here's a question for you. How should retirees think about balancing healthcare costs with long-term retirement income needs?
I mean, I knew that there would be a healthcare question. I mean, it was just inevitable. As far as balancing healthcare costs, I mean, a huge conversation. Also, a lot of long-term care conversations. People are saying, I think their own parents go through a lot of those needs, and they're figuring out, wow, it's really expensive. And so, as far as balancing, that's where the planning comes into play. And so, we always say we do financial plans. We project out all the way until age 90 or age 100, depending on, some people are like, I don't even want to live that long. So it really just depends. But that's why, again, as we go back to diversification is key, not necessarily in terms of just investments, but do you have sufficient cash? You don't want to spend all your portfolio down all the way till end of life because maybe we need that money to allocate for long-term care. Do you have family that's that's going to be able to help you. If you don't, what kind of care do you need? And so it can be tough because I think healthcare costs can really vary. But I think being ahead of it and understanding, okay, I know that in retirement, it's going to cost me, $1,500, $2,000 a month, $1,000 a month, depending on what, your premiums are, depending on what your healthcare needs are. And so getting ahead of it, I would say would be the good thing. And also, it's kind of like a home renovation. Always plan for more than you originally anticipated. And it's good to have buffer. So, don't run it so tight that, you don't have that flexibility. But also, a lot of people have asked me, well, what happens if I run everything to zero and I don't have any money to take care of myself? That's when things like, Medicaid come into play, and healthcare coverage, which again is a whole other thing in
Yeah.
itself. So,
My other thing
yeah.
is giving yourself optionality. So as a young person and even working with an advisor sooner in your life to say, hey,
Yes.
maybe you should be saving into a Roth because down the road we can take money tax free from the Roth account. If we're running up against one of those IRMA buckets, it's like, hey, let's take this next distribution from the Roth instead, so it doesn't count against your taxable income. So it's a thing that you need to plan for, and
Yes.
so, that's why the earlier you can start talking and planning with someone, the better off you're going to be, because then you'll have those options. You'll have your three different buckets of non-retirement, retirement, and post tech, your Roth account. So
I'll
all of
also
those things count.
I'll also say this too. A lot of times earlier in retirement, people are like, I think I'm going to travel a lot more in like the first 10 years. And then later on, that's when I really want to preserve things, be more stable, make sure I have plenty of liquidity in case healthcare needs arise. And so know yourself a little bit. I mean, of course, it's hard to judge that completely, but it is, as Steve said, it's always important to plan for it. But in regards to actual Medicare coverage or, healthcare coverage, meet with a licensed Medicare specialist. That's one of the
Yeah.
best, I think, pieces of advice that I can give you because they know what they can understand what, prescriptions you're taking and what doctors you're seeing and what specific needs that you need based off your, health situation. But stay on top of it. Don't wait. Definitely plan because it's one of the biggest things of retirement for sure.
Yep. Got another one that came through. Do you help devise strategies to help maximize tax savings for estates and transfer of wealth?
I mean, absolutely. I mean, that's, one of the biggest parts. And so everyone has very different goals of what they want to do when they pass. Some people are like, I worked hard for this. I don't want my kids to get anything. My kids are better off than I was. And so that's kind of going back to the beneficiary designations. It could be something as simple of, okay, we list all three kids as beneficiaries, not one of them as beneficiaries. We don't list the trust as beneficiary. So you'd be surprised there are pretty simple things that can be done to make sure that estates don't have that problem. Also, 15 years ago, the estate tax exemption was, 6 million. Now, if you're a married couple, it's, almost 30 million. So it also depends on the laws that are in place. The estate tax exemption is supposed to sunset. I do think they will extend it, but we'll see what happens. But that's why back in the day you saw A and B trust because, well, if, you met that estate tax exemption, then it went to the B part, right? So that's why like those trusts really are kind of there's no need for them anymore because of how high it is. So yes, it is something we plan for. It depends on, value of properties, value of assets. And so as long as it's really under that estate tax exemption, which I think for a single person, it's like 13 million, maybe 15 now, it goes up each year. That's something definitely important, but most people, they're not too high above that. And there's also gifting strategies during life of, hey, I want to give to my kids, how much can I give each year without creating some sort of gift tax problem? 19,000, I think is the gift limit for this year. And so there's strategies both during life and then also after life. So yes, it is absolutely something that's a huge part of our role.
Yeah, that's a big one to me that I've heard a lot more about recently is like, if you're planning on giving lots of money to your kids when you pass, like why not try to give that some of that money to them now? It'll benefit them so much more when they're younger. They can try to save, they can save for that house. They can, to the Gen Z question, the vibes,
Exactly.
and part of the question that I brought up the vibes earlier is because I just saw a stat that the AAII investor sentiment survey came in literally the lowest. It was the lowest reading ever since 1970. Uh, I look out and I go to Home Depot. I was out at Home Depot last week. I was at Disneyland. Like all of these places are packed. And I'm like, what is the vibes out there are so terrible. And again, I think it all just comes down to the news. The news isn't news anymore. The news is trying to get clicks and trying to get your attention. And it's like the news is showing you how everything is so bad out there
Yeah.
versus what we're trying to show you is like, no, things are good, earnings are good and companies are doing well. Like that's the hard part is like I think that the vibes are so bad because you don't know where to get your information from to get good information so that you feel good about what's going on. So it's really tough. It's frustrating. I lived through 2008. I know a lot of other people lived through that, and for me, that was the worst time ever. I lost my job and was out of work for 6 months, and luckily found my job here. But it's one of those things where it's like, man, with earnings doing so well, with really like unemployment, the rate is pretty low. Yes, we do have a little bit of inflation, but let's even talk about that. Let's talk about the inflation picture and kind of the reason for it right now. You know, we went through this whole period back in after COVID where we had this. Everybody's talking about transitory inflation. Um, Again, I don't think transitory is a word we need to ban. Um,
Yes.
we're having a war right now. There's a war with Iran. It is we've the Strait of Hormuz is obviously a big supplier of the world's oil, and we have elevated oil prices currently. The problem with judging inflation based off of something that could end tomorrow, honestly it could end a week from now. We never know when this is going to normalize, and so it's one of those things where to plan for that is very difficult. So where we might make very small trades at the edges and saying, hey, this next 3 months or this next 6 months we're gonna tighten, we're gonna pull back on stocks because of what's going on with the war. The problem is that could change it overnight, and it's very difficult for a long-term plan to be sustainable if you're making huge giant swings with your allocations. And so that's something we're never going to do. We are going to be um, we're going to be very cognizant of all the issues that are happening outside in the world. But when it comes down to it, we're going to plan for the long term. We're going to plan for 20 years. We're going to plan for 30 years. And that's what it comes down to. So whenever we get questions about the war, about inflation currently, it's really difficult for us to answer because you're talking about a short-term situation when we are long-term investors.
100%. Yeah. I mean, we always come back to the financial plan and we also stress test things. I mean, we say, okay, well, what happens if we have recession? Because the truth is, we're going to have one at some point in time. I mean, we'd be lying if we said there wasn't going to be one. And so everything can't always be rosy. There's obviously things that go wrong. There's recessions that happen, but we do learn from them. And that's why preparing not for if, but for when is really a crucial part. And that's why we say, okay, don't run everything to zero, have buffers, have flexibility in place. And what can we do now to prepare for those things? Just because, again, we don't know. I mean, we have a chemical leak that's like 60 miles away. We have earthquakes. I mean, we have wars. There's all these different things happening. So in
Yeah.
6 months from now, it will probably be something else. I mean, we went through a pandemic, almost 4 years ago, which is crazy to think about, but life does happen. And that's why it's so important to plan and to consistently update. I always tell people it's not a static process. It's not a set it and forget it. It's constantly changing. Health changes, life changes, family changes, all those things, apart from even the economics is an important thing to consider in your own financial life. And so that's why it's so important to do the planning.
Yep. Yeah, for sure. Last question here is, are we in a vibe session? There seems like there's a big disconnect between economic data, consumer surveys, and compared to the consumer spending. So to me, it's not the vibes are really more about how you feel about others, not about how you feel about your own situation. And so when you listen to the news, when you read the news, all you're hearing is how bad it is for this other person over here.
Yeah.
And then you go out and you're like, well, it must be bad for everybody else, but I'm fine. I'm going to go spend my money. And so the problem is we have however many percent of people who are thinking that way. And so the vibe is low, even though everybody's out there spending. So it's one of those things where I think it all comes back to the news isn't the news anymore. The news is what can I get you to click on? What can I get you to read? What can I get you to watch? And typically, the worse that is, the worse than that news is, the more likely someone is to watch it.
I'll
Yeah.
also say too, in regards to vibes, because I think a lot of times when it comes to how people feel, they associate it with price. And so now, I mean, and I would be lying if, if I said that we don't get sticker shock. I mean, prices are elevated. We go to
Mm,
the grocery store. I mean, especially, living here in California, looking at the gas pump. I mean, I paid, almost $130 for a tank of gas last week. And so, all those types of things can definitely give more pressure to ourselves. Also, Steve said, to other people. And it, restricts discretionary spending. So maybe we have less people going to Disneyland and some of those things.
mm,
Also, that is okay. I think sometimes people think that a slowdown in growth always equals a bad thing, and it doesn't. It's part of an economic cycle. We have to see slowdowns. I think recently, I've seen a lot of reports of there was elevated spending in like April, May. I think because we had a big stimulus year, we had a big tax refund year.
yeah,
And so I think that helped a lot. We also had COVID where there was a lot of money pumped into the economy. And so I do think we have to get more price stability. I think prices are elevated. I also think that because these businesses can charge the prices that they do and we continue to pay them, they can keep doing it. And so I do think we have to get more to a level ground. But I think, again, just because the market's not always going up or just because people don't always feel good, it doesn't always equal a bad thing. It's okay to have a slowdown in growth to get more of a level. So I would say definitely, I hope to see price stability more in the next couple of years. Hopefully, new Fed president coming in will be helpful in doing some of that. It's
yeah,
tough to say, but I will agree. I think prices are elevated, and I think that's one of the biggest reasons why, sentiment is not great.
sure. One more question came through. How often do you review individual accounts? So technically, like really, I'm monitoring individual accounts every day. So and the reason I can say that is that we run models. So all of our accounts are invested in individual models or even multiple models that we run with different partners out in the world. And so we are monitoring those daily. So it's not like we have, 10 clients that are in this thing and five clients that are in another thing and 20 clients in another. We have hundreds of clients that are all in these models. And so we are monitoring that on a daily basis. Uh, Now, from a more formal, like, what's my tax situation? How is my risk? Like, what should I do? That is more, you need to call your advisor and speak with
Yeah.
them, or we're doing that on an annual basis or semi-annual basis, depending on how often we meet with clients. So it really just comes down to the individual situation when we're updating beneficiaries, when we're doing all of that kind of stuff. But as far as monitoring the actual investments, that is an ongoing process that's happening constantly.
Steve's been instrumental in initiating a lot of those types of things in our firm, which has been awesome. And so a lot of times people say, well, if you're making a tweak here, like what does that mean? And so we'll usually send out an email saying, hey, we made a trade in your portfolio. Here's our rationale behind doing it. But also too, if maybe you saw at the beginning slide, we're celebrating 30 years. We have $1.4 billion assets under management right now. And so if we believe that a trade needs to be made, we're making it across millions of dollars of portfolios. And so it's
Yeah,
not, hey, a tweak here, a tweak there. It's because we believe in the fundamental change and that hopefully, it would get you better return, of course, or we just believe, based on what's happening in the market. So
yeah,
if we're making shifts, it's across the board for everybody that's in that. So, which has been a
yeah,
huge help, from Steve, sure.
for sure. All right, Claire, we did it. We
Yes.
did
Thanks everyone for tuning
it.
in. If
Yeah,
you haven't checked out some of Steve's old Study Time with Steve's, they're awesome. We're always here to help. But if you guys have any questions, definitely reach out to us. We'll be happy to keep the conversation going.
yeah. Thanks everybody for joining, and good luck out there.
Yes.
Take
Good
care.
luck.
Bye.